I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. When you have a traditional tax-deferred individual retirement account, or IRA, you generally have to pay tax on all money you withdraw. And in addition to paying taxes, if you take distributions earlier than age 59 and a half, you also have to pay a 10% penalty. But thankfully, the IRS allows 9 exceptions to this early withdrawal penalty. I'm about to explain what those are. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. I should start by saying that there are some times where you're allowed to take money out of your IRA without any tax or penalty. For example, if you do a qualified rollover of funds from one IRA to another, or if you're going through a divorce and the divorce decree stipulates you have to transfer a portion of your IRA to your spouse's IRA, or if you make an excess contribution to your IRA and then remove the excess. These 3 distributions are neither taxable nor penalized. But outside of a small number of cases like this, all distributions from your tax-deferred IRA are at least taxed. And then if distributions occur before you turn age 59 and a half, you'll have to pay the 10% penalty in addition to the tax. However, the IRS allows 9 exceptions to this early withdrawal penalty. The first exception is if you use the distributed funds to pay for medical expenses that are in excess of 7.5% of your adjusted gross income, or AGI. The expenses need to be eligible to be deductible on the Schedule A of your Form 1040 tax return. However, you don't actually have to itemize your deductions to take advantage of this. Even if you claim the standard deduction on your tax return, you can still qualify for this exception. The second exception is if you use the funds to pay your medical insurance premiums during a period of your unemployment. But you can't just quit your job and consider yourself unemployed. To qualify for this exception, you need to have first received 12 consecutive weeks of unemployment compensation. The third exception is if you are totally and permanently disabled. In this case, there's no limit to the amount of penalty-free distributions that you can take from your IRA, though the IRS uses a fairly strict standard of disabled to qualify for this exception. For purposes of the 10% penalty waiver, they consider you disabled if you can't do any substantial, gainful activity because of your physical or mental condition. Furthermore, a physician must determine that your condition can be expected to result in death or to be of long, continued, and indefinite duration. As you can see, simply breaking your wrist at work won't qualify you as disabled in this case. You essentially need to be in a condition that results in your permanent inability to do any kind of work. Fourth is if you receive a beneficiary IRA. When you inherit an IRA from someone who dies, the IRA technically still belongs to the person who died, otherwise known as the decedent. You, as the beneficiary, are really just the recipient of the income to be distributed from that IRA. And because the IRS makes you take distributions from the IRA, typically all within 10 years of when the decedent died, they do not penalize you for taking money out if you're younger than 59 and a half. The fifth exception is if you receive the distributions as part of substantially equal periodic payments, or SEP, S-E-P-P. The exact mechanisms of a SEP are fairly technical and beyond the scope of this video, but at a high level, a SEP arrangement is when you commit to taking out a series of payments for a minimum of 5 years or until turn 59 and a half, whichever is greater. Furthermore, you need to take a distribution at least annually under a SEP. The IRS allows you to calculate the amount of your payment under one of 3 methods. 2 of those methods will result in a fixed payment amount each year. The third method will result in a variable payment. Once you formally start them, substantially equal periodic payments are not very flexible. For example, if you elect the variable payment method, you cannot stop or alter the payments until it's been 5 years or you turn 59 and a half, again whichever is greater. And if you instead choose either of the 2 fixed payment calculation methods, you're allowed to switch to payment calculation method once, but only to the variable payment option. Regardless which payment option you choose, if you do not continue to take the prescribed payment distributions or otherwise have an approved alteration or cessation of payments, you'll have to pay the 10% penalty retroactively on all payments you received up to that point. Clearly, these substantially equal periodic payment arrangements must be very closely considered before deciding to start one. The sixth exception to the IRA early withdrawal penalty is if you use the funds for qualified higher education expenses. These are expenses you pay for things like tuition, fees, books, supplies, and required equipment to attend a college, university, vocational school, or other post-secondary educational institution. There are some technical requirements the institution needs to meet for its expenses to be qualified, but basically, virtually all accredited, public, nonprofit, and proprietary for-profit educational institutions are included. Also, the expenses don't need to be only for you. You can also use your distributions to pay qualified higher education expenses for your spouse, your children, or your grandchildren. Furthermore, there is no limit on the amount of qualified education expenses you can pay under the early withdrawal penalty discussed here. However, if you receive any tax-free educational assistance or reimbursements in the form of scholarships, Pell Grants, Coverdale Plan distributions, and so forth, you can't claim a qualified education expense for amounts that were paid by those other tax-free sources of money. The seventh exception is to buy, build, or rebuild a first home. It should be noted that there is a $10,000 lifetime limit on the amount of IRA distributions that are eligible under this exception. And if you're married, both you and your spouse can each use up to $10,000. The money can be used toward the cost of buying, building, or rebuilding a home. The money can also be used toward any usual and reasonable settlement, financing, or other closing costs. Also, the home on which you spend the money doesn't necessarily need to be for you. It can instead be for your spouse, children, grandchildren, or parents. Regardless whose house you use the money for, it needs to be the person's first house. But under the IRS's formal definition of what qualifies as a first home, it doesn't need to be the person's literal first home. Specifically, the IRS defines a first-time home buyer as someone who has not had a present interest in a main home during the 2-year period ending on the date of acquisition of the new home. The eighth exception is if the IRS levies your IRA. In that case, since they're not giving you a choice about taking out your money, they're at least kind enough to not make you also pay the 10% penalty. The ninth and final exception is called a qualified reservist distribution. This applies only to persons in the military reserves. And more specifically, it only applies if the reservist is called to duty for more than 179 days. During such duty, the reservist distributions from his or her IRA are exempt from the 10% early withdrawal penalty. The 9 exceptions I just went through apply to IRAs. The list of early withdrawal penalty exceptions is a bit different when it's an employer plan like a 401k, 403b, or the Federal Thrift Savings Plan, or TSP. For example, employer plans don't allow the exceptions for qualified higher education expenses or first-time homebuyers. However, employer plans may allow a pretty important exception that's not allowed with IRAs, and that's called the Rule of 55. The Rule of 55 is when you're allowed to take penalty-free withdrawals from your employer plan if you have a separation of service from that employer in the year you turn 55 or later. As an example, assume you have a 401k at your employer, and you retire or are laid off when you're 56. So long as you keep the money in that 401k and do not roll it over to an IRA, you can take as much penalty-free distribution from that 401k as you want. You'll still have to pay tax on it, but there will be no penalty. And it's important to note that the Rule of 55 only applies to the plan of the employer who you left at 55 or later. For example, if you left a job when you were 40 and kept that 401k open, you won't be able to use the Rule of 55 on that 401k. However, you can potentially roll that old 401k into your current 401k if your current 401k is the one where you are eligible for penalty-free withdrawals under the Rule of 55. Not all employer plans allow the Rule of 55 though. Just because the IRS allows it, that doesn't mean your employer chose to allow it in their plan. Therefore, I'm saying the Rule of 55 may apply to your 401k, 403a, 403b, or a thrift savings plan. Check with your employer to find out for sure. There's one other special exception that some employer plans may allow that IRAs do not. It's a slight twist on the Rule of 55. It's called the Rule of 50. Similar to the Rule of 55, the Rule of 50 allows you to start penalty-free withdrawals from your employer plan if you leave that employer in the year you turn 50 or later. But this rule applies only to a qualified governmental benefit plan and only for public safety employees. If you're unsure if this applies to you, check with your employer. Well, that's it for the exceptions to the IRA 10% early withdrawal penalty. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.